3, 4. We need one member. 3, 4.
Okay.
Have
We
I
need
been
one
counted,
member.
Chairperson? Because my name on the screen is not what I usually use.
Yes,
Have I been
I've
counted, Chairperson?
counted
My
you.
name on the screen okay, thank you. Not what I usually use.
Thanks, Dr.
Yes,
Josh.
I've counted you.
Mrolong.
Thank you. Not what I usually use.
Thanks, Dr. Josh.
Hey, Chairman, how are you?
Counted you.
I'm good.
Hey,
Chairman, how are you? Okay, let me check them quickly.
5.
Hey, Chairman, how are you?
There's only
Okay, let me
5
check
of
them
you
quickly.
in the meeting, sir.
Chairperson, sorry, we have 6 members on the
There's
platform.
only 5 of you in the meeting, sir. Yes, Mr. De Villiers, sorry, yeah, I forgot him. Yeah. Now we do have a quorum. Yes, Mr. De Villiers, sorry, yeah, I forgot him. Yeah. Now I forgot Mr. De Villiers. Yes, Mr. De Villiers, sorry, yeah, I forgot him. Yeah.
Good morning,
I forgot
Chairperson.
Mr.
Good morning, all.
Good morning, De Villiers. You are welcome.
Good morning, Chairperson. Good morning, all.
Good morning, honorable members. De Villiers, you are welcome. The meeting is officially open. Let me welcome members of this committee. The meeting is officially welcome Treasury, National Treasury. I'm not sure if the Deputy Minister is in the platform. If so, is welcome. Welcome the acting DG, Mr. Momo is welcome. Welcome the Commissioner, Mr. Kisweta and his team. Welcome the parliamentary support team, including the PBO, legal services, communication, and all the officials from Parliament. Welcome the media and the public at large. The purpose of today's meeting is to get a briefing from National Treasury about the TLAB, the TALAB, and the revenue bills that have been referred to this committee by the Speaker after they've been tabled by the Ministers Committee. Let me not take much time. Are there apologies? Take much time. Are there apologies?
We have an apology from Honorable Skosana.
Okay, this apology from
We have
Skosana
an
is
apology
attending
from Honorable Skosana.
what do we call it? One
The
section.
section 194.
Yeah, section 194 committee. Okay, that's the apology.
Section
And
194.
then let's move to the next item and call upon the acting DG, Comrade Momo, to lead on that platform, and then the commissioner. Over to you, Comrade Momo.
No, thank you, Chair, and to honourable members. Chair, yes, this is the annual ritual, and just to remind ourselves, and Chair, just from your comments, we've also got the TLAB, the TALAB, the Revenue Laws Amendment Bill, but we also have the Rates and Monetary Thresholds Bill. And Chair, just to remind members, these are draft bills. They've not been tabled yet. And Chair, the tax process, just to remind ourselves, we release these on the Treasury website and the SARS website, and then have the hearings, because except for one, all the bills are money bills, and there's the procedure that you have to deal with changes to money bills. And honorable members, just again to remind ourselves, I mean, with tax bills, the issue is really that we don't have prior consultations before the budget, and because tax proposals are sensitive, sort of market sensitive. They're basically just announced by the Minister of Finance on budget day. So sometimes there's a bit of shock and awe, particularly when the Minister announces a new tax or increases a tax, and consultations only start after the announcement. And for that reason, it's quite possible that we have to make changes to the proposals that the ministers announce. And so if you look at the process, what tends to happen is after the minister announces, we need to do some technical consultations on some of the proposals because we've not been able to consult before. And that's what takes us between February and basically July, when the TLAB and TALAB bills are published, and in this case the Revenue Laws Amendment Bill. With the rates bill, that bill is published, the draft is published on budget day, because they only relate to the rate changes. We don't try and normally don't try and deal with any other complex issues. So, Chair, we've got a big team. From the Treasury, we've got Yanga, Buddha, and Chris Axelson, and their teams in the Treasury. And from SARS, I didn't see the Commissioner, but the Commissioner is here, and Franz Tomasek sort of lead their teams from SARS. But just to go through the process this year, Chair, honorable members, because there are some significant proposals, and the big one relates to the retirement, the two-pot system, which is a change that's been brought through the tax bill, and you can expect, I think, to have quite a lot of comments on those, and for that reason we kept them in a separate bill, but Yanga can explain that in more detail. So what happened was, once the minister announced on budget day, as I said, we published the rates bill, and if you look at the overview, it was first published on budget day, and then we published again on the 29th of July to solicit comments. But in between, what happened with the rates bill was that we saw that, I think it was just a day after the budget, when Russia went into Ukraine, and it had an impact on oil prices and on many other prices, and we faced a lot of pressure when the fuel price shot up. So announcements were made on the fuel levy, which had led to changes in this bill. So normally, as I said, the rates bill contains, sorry, I don't know if the slides are on. Chris or Yanga, I don't know who's running the slides. So just to get to the first slide, the rates bill was published on budget day, and it contains the tax announcements made in the 2022 budget. So it deals with changes in rates and monetary thresholds and increases of the excise duties on alcohol and tobacco. It also contains changes tabled by the Minister in Parliament on 31st March 2022 and 31st May 2022 regarding temporary relief on fuel levy, as well as the postponement of the effective date of an increase in the health promotion levy, which we delayed by a year. So this bill, the draft rates and monetary amounts and amendment revenue laws bill, therefore, as I said, was published. Every time there was a change, we published it, and we published it again on the 29th of July, and it contains the proposed amendments to the Income Tax Act with the two-point retirement system. The proposed amendments give certain sorry, that's the revenue laws amendment bill that I'm talking about. So that was published on the 29th of July, and it contains a two-part retirement system proposal. And these amendments all give effect in all these bills to the announcements made in February last year. And on the two parts, it was an announcement that was also made in November last year, when we published and followed a discussion paper that we had published. So next slide, please. Discussion paper that we had published. And then with regard to the TLAB bill, the Tax Laws Amendment Bill, which is a money bill, all the previous bills that I've mentioned, the revenue laws and the draft rates and monetary amounts bills are Section 75 bills in terms of the Constitution, or money bills, I should say. And similarly, the TLAB is a money bill, and that contains the remainder of the tax announcements that are made in Chapter 4 of the Budget Review, the Minister's Speech, in Chapter 4 of the Budget Review, and what we call Annexure C in the Budget Review, which are all the technical improvements and changes that we had to make. And following the budget, and following some of these issues, there were also technical consultations held with selected stakeholders, just to help us prepare for the coming legislation. So we had to look at the impact of IFRS 17 contracts on the taxation of short-term and long-term insurers. We had to clarify the definition of contributed tax capital and clarifying the tax treatment of collateral arrangements. We'll speak through these, Chair, but we're just alerting you to the process itself that's taking place. And then, of course, we have the TALAB bill, which deals with all the administrative issues, and the TALAB bill itself, that's a Tax Administration Laws Amendment Bill, actually is a Section 76 bill, because it's not a money bill. And in terms of the Constitution, we have to split the bills between the money bills and the non-money bills. So there's two separate types of bills that we have. And as I said, money bills are in terms of Section 77 of the Constitution, but they then get treated, as I said, in terms of Section 75 in terms of process, but Section 77 adds further details to compel that only the Minister of Finance can introduce them in Parliament, and that they have to start in the National Assembly. The tax bills and sorry, I've had my numbering wrong. And the non-money bill, which is the TALAB bill, is also dealt with in terms of Section 75, but it's an ordinary Section 75 bill. So there's no Section 76 in this process. So the draft bills, as we said, were all published on the 29th of July on the Treasury and SARS websites. And we also take comments which we bring to Parliament, but the primary place to comment is to Parliament. But just to give us some notice on some of the areas that come up, and as we know, then between SCOF and CCOF, in that sequence you have public hearings on these draft bills. And Treasury then engages with many of these stakeholders, because this is the first time they actually have to actually look at the detail as it's going to be legislated. So in February they've heard the announcement, and they still don't have all the details, the nitty-gritty of how the tax will be implemented. That is only done when they see the July version, the 29th July version of the actual bill. So it's quite a tight process, Chair and Honourable Members, as you know, in terms of time. So we look forward to those comments, and then we obviously under the committee, the bills get processed, we come with a response document and so on. Next slide, please. So that's just the process. I know it's been a mouthful, lots to talk about. Now we come to the specific bills themselves, and starting with the rates bill, which we, as we said, went through 3 rounds of changes, if I'm not mistaken, but Yanga can correct me. Yanga, are you going to come in, or Chris? I don't know who's going to do these slides. To talk about. Now we come to the specific bills.
I think I was going to do these ones.
Okay, Chris, coming.
Thank you. Good morning, honourable members. Morning, Chair. So we presented to the committee on the draft rates bill, which included the changes to the personal income tax tables, the changes to the excise duties on alcohol, changes to medical tax credits. So a lot of the rate changes that were announced in the budget in February, we presented that to the committee on the 22nd of March. Since then, as Momo was saying, there have been a couple of changes to the rates bill that we've since put in. So just to quickly run you through those, the first one was on the fuel levy. So the fuel price had increased quite dramatically, really. And we initially implemented a 2-month reduction in the general fuel levy of R1.50 per litre. So that was from the 6th of April, and we were doing it for 2 months. So it reduced the levy by about 40%. It was going to cost us about 6 billion in lost revenue. The plan was to sell the strategic oil stocks to pay for that, and that is still the plan, and that is what is being done. And we also announced some other measures to try and limit the increases, in the fuel price. After a couple of months, on the 31st of May, the price was still going up, and we extended the temporary fuel levy relief for another 2 months, where we did R1.50 reduction in fuel levy for 1 more month in June, and then we dropped the fuel levy relief to about 75 cents for the next month. And that ended at the end of August. That was going to cost about 4 billion in revenue forgone, and that's expected to be taken into account in the fiscal framework in the medium-term budget policy statement. So those 4 months of relief are then included in the revised draft rates bill. And at the moment, that relief has ceased, and luckily the prices are coming down and should come down again next month. The other measure that we have adjusted in the rates bill since we last presented to you is the implementation date of the health promotion levy. We had stated in the budget that the levy itself would be increased by 4.5% to 2.31 cents per gram, and we said that was going to start from 1 April 2022. We did also announce that we were going to start consultations on lowering the threshold for the health promotion levy. Currently, the threshold is 4 grams of sugar per 100 mils. So if you have a lower sugar content than that, you don't pay the tax, and if it's above, you only start paying the tax from 4 grams onwards or upwards. And also to extend the levy to 100% fruit juice. However, we did have consultations with the Minister of Agriculture, Land
Recording in progress.
And the Minister of Trade, Industry and Competition. And after those consultations, we released, the Minister of Finance released a media statement on 1 April 2022 to delay the implementation of that 4.5% increase for 1 year to 1 April 2023. So we are going to still have consultations on the threshold and potentially extending it to 100% fruit juices, and we will do that as soon as we've released a discussion paper, which should be out very shortly. Thanks, Mama. 4.5% increase.
No, thanks, Chris.
To 1 April 2023.
So
we are going to still have consultations on the
as I said, quite a
threshold and potentially extending it to 100%
big
fruit
area
juices, and we will do that as
of
soon as
interest,
we've released a discussion paper,
which is the draft
should be out
laws amendment bill, which deals with the two-pot retirement system. I'm going to ask Alvina and Stella and Basil Maseko to come in and walk through the slides and make some comments, perhaps in between. But over to you, Alvina and Basil. Laws amendment bill, which deals with the two-pot retirement system.
Thanks, Mama, and good morning, colleagues, Chairperson and honorable members. So I think as Mama mentioned earlier,
comments, perhaps in between.
sorry.
But over to you, Alvina and Basil.
Okay, great. I think, as all you might be aware, the South African government embarked on retirement reform since 2012.
Rina, you must put your camera on
So I think as
as well
Mama
whilst you
mentioned earlier.
speak.
Oh, sorry, I had put my camera on, but I didn't switch it on. Sorry about that. I think, as all you might be aware, so as I was saying, guys, I think we might all be aware that South Africa embarked on the retirement reform process in 2012, even though actually dates way before that. Likely to address gaps, addressing inadequate retirement provision for members. There has been some significant progress since 2012 on a number of reforms, and these include the harmonization of the tax treatment between different types of retirement funds, as well as the annuitization by Provident Fund members since 2012. So the current, you can move to the next slide, Chris. So the current policy and legislative proposal follows the announcement that was made by the minister and the subsequent release of the discussion paper in 2012. The main proposal here is to address the disharmony in preservation between the different retirement funds. The intention with the policy proposal as well as the legislative changes is to introduce a two-part system. Maybe some might say three parts, but we call it a two-part system. Those parts include the savings part, the retirement part, as well as the vested part. So the two-part system retains the current tax regime of EET, exempt tax. We also retain the tax deduction as is, 27.5% of gross remuneration up to 350K per year. The proposal is to start with the two-part system from 1st of March 2023, or you can say to house the three different parts from 1 March 2023, with the vested part being everything that has been accumulated before the system kicks in, and the savings part plus the retirement part starting from scratch. So the savings part, the proposal is that there is no seeding that will be allowed in the savings part. It will start from scratch. A maximum amount of new contributions. For argument's sake, let's say the system starts from 1 March 2023. A maximum of 1/3 of a member's contributions would go into the savings pot. We will not allow excess contributions into the savings pot. And amount contributed into the savings system in excess of the tax deduction will be moved to the retirement pot. The savings pot will allow withdrawals over a 12-month period. However, if a member does not withdraw in that 12-month period, that amount can be withdrawn in the following 12-month period. A minimum withdrawal amount is 2K. Withdrawals from the savings pot will be added to a member's taxable income in the year of the withdrawal and will be subject to tax in the hands of the individual. Normal income tax rules apply. A member cannot transfer into the savings pot, but they can move money from the savings pot into the retirement pot. But new money in excess of what is allowed in the savings pot cannot go in. On the death of an individual member or at retirement, any amount that is available in the savings pot will be taxed in terms of the retirement lump sum tax table. And also when a member ceases to be a tax resident for an uninterrupted period of 3 years or leaves the country when their visa expires, that amount can be withdrawn subject to the member's normal tax income. I can move to the next slide. And the retirement pot, this is the pot that will be subject to full preservation when a member member resigns or changes jobs. Not less than 2/3 of a member's contributions should go into the retirement pot. Contributions that are allocated to the savings pot that are not allocated to the savings pot can go into the retirement pot. As I've mentioned earlier, any excess contributions to the savings pot will fall or follow into the retirement pot. Because this is subject to full preservation, when a member resigns, they cannot access contributions that have gone into the retirement pot. At retirement, the retirement pot is subject to full annuitization, subject to the de minimis threshold, which is 167,500. So if whatever a member has accumulated in the retirement pot is below this de minimis threshold, they can choose to annuitization. I've mentioned that savings or excess contributions can go into the retirement pot. Also, transfers can be made into the retirement pot, but transfers cannot be made out of the retirement pot. Similarly, when a member leaves the country and ceases to be a tax resident for an uninterrupted period of 3 years, or their visa expires, they can withdraw what they've contributed into the retirement pot, subject to the withdrawal tax table. And ceases to be a tax resident. So the vested pot is all contributions and growth that a member has accumulated prior to implementation date. So that retirement interest will be accorded a vested right, meaning that when a member resigns, they should be able to withdraw this vested pot if they choose to, or they can transfer it to another fund if they choose that option. So that retirement interest so no contributions will be allowed into the vested pot. What a member has contributed before the two-pot system comes into effect will be ring-fenced as a vested pot, subject to current rules as we have them now. So no contributions are made into that pot. But when a member resigns, they can withdraw that or transfer that. The difference will only apply to Provident Fund members who were 55 years and older on 1 March 2021. They had a vested right when the annuitization requirement came into effect. That vested right will continue with the two-pot system. Vested rights or the vested pot can be transferred from one vested pot to another fund vested pot free of tax. Similarly, when a member ceases to be a tax resident for an uninterrupted period of 3 years, or their visa expires, they can withdraw what is in the vested pot, subject to the current tax system that applies, so that will apply prior to the implementation of the two-pot system. Also, when a member retires, the two-pot system will be treated in terms of the current rules or the rules that applied before the two-pot system came into effect, meaning that if you are in a pension fund, you have to annuitize 2/3. If you are above, what you've accumulated is above the de minimis. I think I've spoken to this last bullet that rules of the fund applicable prior to the implementation of the two-pot system will continue to apply to the vested pot. Thanks, Mama. Thanks, Chair.
Yeah, no, thanks, Chair. Chair, let me just add a few points just on this two-pot system. I think what we'll also do is, as you would have seen in the media, there's a lot of focus on this, you know, and often for the wrong reason. No, thanks, Chair. The issue for us is how can we get more preservation? As it is, we as South Africans, we don't save much. And whilst we have a good system with those who are employed and getting salaries and covered by bargaining council arrangements, generally do contribute towards a work retirement fund, we find that they don't save because we have a gap in our system where when people resign from work, they then access all their savings. So by the time they retire, they have very little left. And if there's one way to also make sure we build asset wealth of employees and those working and who have retirement funds, it's quite critical that we focus on preservation. But you know, we don't take a pure approach on preservation. In some countries, you can't withdraw at all. We accept that at some point in their life, work cycle, people go through specific difficulties or emergencies, and hence we've created the savings pot. We really don't want them to also start withdrawing from their savings point needlessly. They should try and preserve it as much as possible. So the approach we're taking is that because the whole retirement system is so linked to the tax system, where your contributions, for example, are deducted, you receive a tax deduction, that we've had to make the changes through the tax system in creating the different pots and making sure that on the one hand, people are preserving and we have certain incentives from the tax system to get people to continue to preserve. I should add, Chair, that once this basic architecture is finalized, we'll be, through normal pension legislation, looking at how we can improve the incentive structure to get people to save more and over longer periods. So, for example, we hope that for many funds, if the current contribution is 15%, that perhaps they'll take it to 16 or 17% towards the savings pot, so that people are encouraged to save more. And if you look at all the other pending retirement reforms, we've had quite a lot of reforms to harmonize the tax system between Provident and pension funds. But what we want to do is, we've said, we want to get a system of mandatory contributions. So even if you work on contract, that you have to put aside a certain percentage towards a retirement fund in your name. And so those systems, I think, will also expand coverage, and those we hope to do early next year. So there's a few outstanding reforms. What we will do, Chair, is just make to members available some of the statements we've put out on these changes and some of the Q&As and so on that we have. And I do expect this area to receive lots of comments. We've had to make lots of judgment calls. This is not the only way to do it. And you know, how you withdraw, the whole issue of seed funding, all of that will come into focus, I think, when we have the hearings. But next slide, please. So just to close the loop, I think, on this, I think we'll just go on to TLAB. I don't know who's coming in, Chris or Yanga.
Hi, Momo. Good morning, members. I will start with the draft TLAB. The draft TLAB has different sections. We are starting with individuals, employment, and savings. The first item there is reviewing the timing of accrual and incurral of variable remuneration. This proposal is assisting taxpayers. Currently, the Act makes special dispensation for variable remuneration and makes provision for the deferral of the taxation of variable remuneration to the date when the amount is received by the employee as opposed to when it accrues to the employee. And this applies only to variable remuneration as defined in the tax legislation. And Section 7B defines variable remuneration to include overtime pay, bonuses or commission, allowances, an amount in which the employee is entitled to as a result of unutilized leave, and night shift and standby allowance. It came to our attention that even though commission is included in the definition of variable remuneration, however, the commission that is included there does not cater for informal sector commission, whereby such commission is calculated based on units produced. So that came to our attention. And in order to cater for the informal sector commission, because the current commission that is catered there is the formal sector commission, it is proposed that changes be made in the legislation to cater for the informal sector commission and change the definition of variable remuneration to include the kind of commission that is received by the informal sector. Thank you. The next slide. Apportionment of the tax interest exemption and capital gains tax annual exclusion when an individual ceases to be tax resident. In 2012, clarification was made in the Income Tax Act to provide that when an individual ceases to be South African tax resident, that individual's year of assessment is deemed to have ended on the date immediately before the day the individual ceased to be tax residency. And that clarification was made because there was a court case, trade-hold court case. So after that court case, we were forced to make that clarification in the legislation. This section further provides that the individual's next succeeding year of assessment is deemed to commence on the day on which tax residency is ceased. Now, it came to our attention that the above deeming provision result in the individual having 2 years of assessment during any 12-month period. And that makes it possible for the individuals to double up on certain exemptions or exclusions that are allowable per year of assessment. And this is against the policy rationale. For example, these exemptions like your interest exemption and your capital gains tax exclusion. So in order to address this anomaly, we are making changes to Section 10 of the Income Tax Act dealing with exemption, the interest exemption, as well as paragraph 5 of the schedule dealing with the capital gains tax exclusion, so as to apportion the interest exemption and the capital gains tax exclusion to cater for a situation whereby the individual can have 2 years of assessment in 1 year. Thank you. Now, we will be dealing with the retirement, and I'm handing over to Nomvula, who's our specialist in this.
Good morning, everybody. The first retirement-related issue deals with the transfer of total interests in a retirement fund. So as the legislation currently stands, members of retirement funds are allowed to transfer their retirement interest from one retirement fund to another. These transfers are, however, subject to certain conditions, namely that the transfer be from either a similar fund to another similar fund or from a less restrictive to a more restrictive fund. And instances where the individual is a member of a retirement annuity fund, such transfers need to be a transfer of the total interest in the transferor fund. Now, as relates to retirement annuity fund members, the fact that they are required to transfer their total interest limits their flexibility in instances where an individual has more than one contract within a specific retirement annuity fund. Now, to afford members of retirement annuity funds a certain degree of flexibility, what is being proposed in this year's legislation is that individuals be allowed to effect transfers of on a per contract basis. However, such transfers will, however, be required to meet certain conditions as a means of ensuring that the current RA de minimis is not contravened. Next slide, please. Okay, as Alvina mentioned when discussing the two-part system, there were a number of retirement reforms that were effected from 2013. One of these is the annuitization requirements for Provident and Provident Preservation Fund members, which came into effect on the 1st of March 2021. Now, as part of these reforms, a distinction was made between historic and new vested rights, historic being vested rights that accrued prior to 1 March 2021, and new vested rights being those that accrued with effect from 1 March 2021. Now, subject to meeting certain conditions, historic and new vested rights will remain protected. It has, however, come to our attention that as the legislation currently stands, in the event that an amount is transferred into a public sector fund, historic vested rights, the protection, of historic vested rights will be forfeited. This, however, goes against the policy intent. So what this proposal intends to do is to clarify that historic vested rights will remain protected irrespective of which fund it is being transferred from or into. Next slide, please. Okay. Now the following amendment follows from consequential changes that were made following the coming into effect of the annuitization provisions. Now, as the policy intent currently stands, any annuities received from a retirement fund, irrespective of the type of fund that they are received from, are to be included in the individual's gross income. But as the legislation currently stands, pension funds, which operate in the same manner as provident funds, are not covered in the current provisions of the legislation. This despite the intention being that they also be included. So what this amendment proposes to do is to clarify that irrespective of the fact that the pension fund operates as a provident fund, annuities received from said fund should be included in gross income. So basically the intention of this amendment is to ensure parity across all the various retirement funds and to ensure that legislation and practice speak to the same thing. Next slide, please. Okay. So another intention, if I can put it that way, of the retirement reforms